You're 55 years old and you just inherited $500,000. Now, if you're like most of the people we see, you may be asking yourself a very simple question: now what do I do? That's what we're going to look at in our video today. Hello, my name is John Vandergriff. I'm one of the owners and the wealth planning team lead here at Blue Ridge Wealth Planners, where we help people walk through situations much like the one we're going to see today. And if you do find yourself in this position, we would like to send condolences to your family, as you probably inherited this from somebody that you care about. And if that's very fresh, the answer to this question may be nothing for a period of time, okay? So, because again, you do not want to make emotional decisions, but now let's assume that you're at a point where you're trying to make plans and decisions. We want to provide a video here, or several videos, that can give some guidance to really what this can do and how this can be a part of your plan. So as we start here, I always like to point out, when it comes to inheritance, and we've seen this a lot, inherited dollars or inheritance money without a plan can very much be like lottery winnings, meaning that you've got money that came into your situation very quickly, and if you don't strategize how to make it fit and graft well into the situation that you currently have, it could leave just as easily as it came in. So we want to look at this and see how we can do some plans. Will you do some things that you wouldn't normally do with this money? Potentially, and that's what we're actually going to look at in this position today with a couple who may want to retire early now that they have a windfall of money that's come in. So as we look at this, first step whenever you have a conversation about inherited dollars is what kind of money did you just inherit? Because not all of the money that you inherit comes to you and affects you the same way. So what we're looking at here is an example of the three different types of tax buckets that exist. Pre-tax, which is going to be any kind of 401k or IRA that has not been taxed yet. After-tax, which will have a variety of options inside of. And then tax-free, specifically with a Roth account. Those will be handled differently than the other two buckets. So as we look at this, if you inherited, starting with a pre-tax amount, an IRA, a 401k, some type of company plan that they're trying to get you to make decisions with, this is all going to be taxable money. In fact, the most taxable inheritance that you can receive. And when you look at this, sometimes if you don't have the right guidance, you can pay all the taxes on this at once without really having to. So when we have dollars that are pre-tax inheritance, you do have the option to either receive it as a lump sum, if that's what you so choose to do. That's not typically the recommendation here. And that would generate a taxable event the year that you receive those funds, and then those dollars would basically move into the after-tax camp at that point. Or what more commonly should happen is you can place those funds inside of what's called an inherited IRA in your name, and based on the way that the rules are now, you would have a 10-year period of time for you to be able to withdraw these funds. And again, depending on how old the person was that you inherited this from, it may have mandatory distributions if they were already taking mandatory withdrawals, or you would have the flexibility to take it out at your schedule over the 10 years. But the caution with this, if you set it up on this runway and let's say the person wasn't taking distributions annually, you've got to be careful, because if you leave this alone for 10 years, it could continue to build a tax burden that you will have to liquidate once you reach the end of the 10-year runway here, and that could be a sizable amount of taxes at that time, especially with a 10-year growth on it. So again, normally the recommendation here is to put these funds in an inherited IRA and then figure out what is the best strategy to withdraw those funds out over that 10-year period of time that the government now gives for these inherited dollars. Now, if we have after-tax investments, most of those will have what's called a stepped up cost basis, which means that, let's say this would apply to real estate, that you inherit. It would also apply to stock positions that you inherit from somebody. You aren't going to pay taxes on the difference between whoever you inherited this from and what you receive it at. The way it's structured now, if it's a investment that's eligible for this, you would basically get the tax basis updated to the date of death value for that position, whether it was a stock or a real estate holding. It would update to that, and then your tax or decisions in the future would be based on that new amount. If you sold it immediately, you wouldn't have taxes, or if it lost from there, it would be a capital loss or a capital gain. So as we look at this, that's an important thing that we have to factor into inherited money, because sometimes people think, I've got $500,000, I'm going to pay through the nose in taxes. We're going to look at this situation and see what the tax ramifications are based on the way it's broken down. But not all after-tax buckets are this way. If you inherit dollars in a after-tax annuity, the cost basis of that annuity does not step up, and then you would have a taxable event on the growth that the person had over their lifetime. So again, that's one of those things that is a little different. I'll put a star by this just because this is something that's a little unique in the after-tax perspective. And then the last one here, we'll kind of break down to two different categories. The first one is you do receive life insurance proceeds tax-free from the death benefit. But once you receive them, there's no taxable event. But anything you invest this in, again, is going to go back to this after-tax frame of mind moving forward, which means the initial amount is not taxable, but the gain on that money, if it's dividends and interest, it would be every year. If it was long-term gains, it will just create a taxable event for you some point later. The Roth account, though, is different, and I think Roth IRAs or Roth 401ks are by far the best money to inherit, because not only do you receive it tax-free, but just like we talked about over here, if you moved those funds into an inherited Roth, why my pen is giving me trouble today, you would have that same 10-year runway for this money to continue to grow tax-free. Now, if the person was RMD age when they passed, you could have forced distributions. Those will not be taxable, but it's the same time frame where after year 10, this money would be forced out as a distribution, have to go into tax or after-tax investments from that point forward. But you do have a 10-year runway post when you inherit these funds to be able to get some tax-free accumulation, which is fantastic if you have it. The situation we're looking at today does not have that, but it is a good option if you inherit those funds. Now, one question I do get from people, because we have a lot of videos talking about IRA to Roth conversions, you cannot convert an inherited IRA and move it to an inherited Roth. That would make a lot of sense, but because of the time nature and also you just receiving these funds, government does not allow conversions in inherited accounts. So, good thing to remember there. So with this particular situation, they had $500,000 broken down, and this was a beneficiary who was one of two. So essentially the estate that was passed was $1 million broken up into $500,000 chunks. So we see the first line item here, $200,000 from the home that they lived in, selling that, and again, because of stepped up cost basis, they would not have a taxable event on that $200,000. Then they have an IRA, so if they did take that out as a whole, that would be $100,000 that would be added to their income taxes for this year. But if we move that into the inherited IRA position and strategically take from it over the next 10 years, that significantly lowers the tax impact of that money. And then a brokerage account that was invested in stocks, those also had a stepped up basis and were liquidated whenever those were moved into the new account owner's name. So again, another zero taxable event. So because of this, by paying attention to what kinds of dollars, but also making some strategic moves here, we can avoid having a lump sum huge tax bill here because of stepped up cost basis on these amounts, and then moving this to an inherited IRA where distributions would have to start the following year for this particular beneficiary. So as we look at it, we need to understand what kind of money it is. So we've got that now. Then we need to understand what type of situation we are trying to graft this money back into. Because again, as we look at planning, especially with our clients, we do not want to try to plan for inheritance until we have it and we know what it is. So this particular situation, you know, they made their recommendations or plans based on what money they had. Now they're adding in $500,000 divided into the tax buckets that we'll outline in our next screen. So again, 55-year-old couple, married, they together have $600,000 in combined 401ks. They also have $20,000 in the bank just for their kind of full balance sheet pre-inheritance. Their main goal, now that they have almost doubled their total net worth, is can we retire early? Which is a good question. So what we want to do is look at their situation, see if that's possible now with this infusion of inherited dollars. And another thing that works for their benefit has to do with their ages being 55 years old. So there is a rule that goes in place to 401ks or retirement plans called the Rule of 55 that says if you retire at 55 or later, and again, this is really for the window between 55 and 59 and a half, you can avoid the 10% early withdrawal penalty on any funds that are left inside the 401k and then distributed from there. So how we compare this, if we took money and we rolled it into an IRA, 59 and a half is the threshold that you can't touch it without a penalty. If you leave some of those funds inside of the 401k, 55 is the threshold that you have to cross, and you have to retire at 55 or later for this to be the deal. So if you were 50 and then you've aged into 55, so you retired at 50, aged in at 55, you do not get this rule of 55. It's only for people who retired 55 or later. So again, with this particular situation, the inherited dollars give them some flexibility. Also, them reaching the age of 55 also gives them some flexibility to where this conversation around retirement could be an option, again, depending on how we set things up. So what we want to look at, as if you've seen any of our videos before, this is a screen that we use often, talking about a plan for everything. So starting with goals and objectives, as we said, wanting to retire now if possible. So trying to investigate that decision. They want to stay debt-free. So that's one of the things that also is working in their favor to help them potentially have this. And then they want to create some tax diversification. Up to this point, basically everything was in pre-tax dollars. Now that they have some money outside of that, they want to see if it makes sense to really create money in all three of the tax buckets. So as we look at this, based on them being debt-free, their need amount right now is $5,000 a month, or if we gross that up to retirement income, and living here in Tennessee with no state income tax, $64,000 a year. So because they are not old enough for Social Security, both of these are their 62 amounts, they would need to take $64,000 off of the $1.1 million, which if you were trying to retire now, this is going to be greater than 5%, which would not be the normal recommendation, especially for a 55-year-old, because with longevity, that's probably too high of a pull to have long-term. But even with inflation factored in, they're going to be adding basically $50,000 of income in 7 years. So as long as we structure the investment plan to support it, this could be a time where they could consider retiring. Because again, even with inflation factored in, they're probably going to have a net need from their investments here if they can keep the bucket relatively the same of at least half, probably less than half of their money after Social Security kicks on. So we want to make sure that we graph that into the conversation here, because again, if we move from 5% need to 2.5% or 2%, then that creates a much healthier picture for retirement and gives them the likelihood that these funds can be able to be used for longevity purposes. So as we kind of scoot that over, part of that conversation now is maybe having some of these funds that have less risk to support such a high income need, but then also keeping some funds aggressive for longevity purposes. I'll show you how we broke that down in this projection we'll look at. And again, when we move to kind of the next point here of tax diversification, if they were to retire and now have an annual income of $64,000, their top tax rate would be 12%. And so the question is, does it make sense to start taking some of these pre-tax dollars that are going to be taxable at some point if they don't spend them, and start migrating those dollars down to their Roth bucket for conversions? Obviously, the $100,000 that's in the inherited account would not be eligible, like we talked about. But the other $600,000 would be. So if they could start paying 12% tax on that, that would give them a tax-free bucket to give them that tax-free diversification that they're ultimately looking for. Now, as we start to look at this, one of the challenges with people retiring earlier is, long-term care is something that more and more people are needing, but also how do they build a bridge to get them from where they are now to 10 years down the line with Medicare? So as we look at this, they had built some money into this estimation. I'm going to show you how they maybe didn't budget enough. So what can we do to try to adjust things to make sure it's supported in the event that maybe you don't budget enough toward health care? Because those are some things that can be some moving targets that you may not know before you retire, but you find out as you start to do some research. So, but again, with this broadly, and really we're looking later in retirement, one of the benefits of creating tax diversification is so that we can have more liquid after-tax savings in the event that we need some type of care, to make sure that we're able to provide it without having to fork out money that we're going to have to pay a lot of taxes on. So again, right now, they've got $420,000 that's liquid after tax. The goal would be to do some conversions, pay some dollars of tax out of this after-tax bucket to try to increase how much of their net worth by percentage is going to be representative of this liquid after-tax threshold. So they're in a position today, when they inherited this money, it kind of encouraged them, I don't know if that's the right word, woke them up to the fact that, hey, maybe our estate planning documents aren't where we want them to be. So they did go through that process and get wills, powers of attorney, not a trust in this particular situation. And then they established beneficiaries on the new accounts that they had, but also existing accounts to where each other was 100% primary, and then 3 kids with equal split to each. So as we look at this, kind of grafting this money into this situation, making sure that we do understand what metrics we need to evaluate, where maybe we've got a higher withdrawal rate now, which is fine as long as we plan for it and know that we've got some relief coming with Social Security later. That could be a very good thing. Now we want to start to run it through some projections and see what this looks like. So this is a software program that we use that will show some percentages, but then we'll also take this over and show it in just some linear graphs. But what I wanted to look at is based on the current expenses that we looked at and building a plan, and I'll show you, some of the way that was broken down. They would have a 97% probability of success. And basically what we're looking at here, and this is not investment recommendation. We would need to walk through this one-on-one with yours, but basically their 401ks have a 75-25 split between the Russell 1000 Growth Index and a Barclays Aggregate Bond Index. And then the inherited dollars are a 60% stock, 40% split of those same 2 options. Cash is just cash. So again, we're trying to keep things relatively simple in this. That may not be the way you're positioned now. It may not be the way you need to, but this just gives us some numbers to look at. So So like we said, if we look at their goal planner before or currently, if we were able to allocate those things that way, this would give them a 97% probability of success. If they were to retire before the inheritance kicked in, they would only have a 43% chance of success. So as you look at it, the need that they had up front would start to really eat into their money too quickly and cause them to run out of money. And we'll look at that chart in just a second. And then, as we talked about, going through the conversation of retirement, they realized that they were about $15,000 short a year on what that medical cost would be between now and 65. And so updating that, they were still over a 90% chance of success, which is what we want to see. We want to see 90% or higher. If it's a college A, it's a good thing. So then we want to look at this and just see with some projections what those look like. And again, we're not showing any conversions in this, just to be, fairly vanilla here. So we're not showing the tax diversification at this particular step. So again, this is the projection. And we'll look at it in today's money, not future money. So you see where they're a little over $1 million, their money's dropping because they have larger withdrawals. Once they get to Social Security, it starts to level out. And then once they reduce their costs with medical cost, then you see that money start to grow. So again, leaves them with more money than they started with based on these projections, versus if they tried to do retirement before they receive this inheritance. You can see the breakdown here where basically they run out of money at age 86. So as we look at that, that's not ideal. That's where we've got to really measure the needs that you have and what's likely. But also I want to compare, the plan, but then also looking at the effect of adding an additional medical expense. Obviously you see here, it starts to pull that bucket down a little further. And then it starts to limit, some of the longer term growth potential, but they're still in a position where they have a good chunk of money in today's dollars that they can either send as an inheritance or utilize for long-term care purposes in these latter years to be able to support them in retirement. So, as you look at it, they may make the decision to retire and then know that they've got this increased cost. Maybe they choose to work in a job where they're basically working for health insurance, so their picture looks more like this. Either way, this shows that this could potentially work based on the situation we're looking at. So as you look at this, you may be in a position where you don't know where to go. You've inherited this money. You're not really sure what the next step is. I would encourage you, reach out to our team. You're going to see a link below this video. We are used to having these conversations. We've been working with retirees for over 20 years now, and we would love the chance to sit down with you and share some of the wisdom that we've gleaned from many years of working with people, but also really help you weave these things in a positive way to your financial picture so that you can utilize these dollars in the best way for you. So again, we'll walk through a conversation like this. If it makes sense for you to work with us, we can help manage and coordinate a lot of these pieces for you. But more than anything, we just love the opportunity to help you any way we can. So hopefully you enjoyed this video. We look forward to spending some more time with you, but that's all we have for today.